All right, it's tax season and everybody wants to pay less taxes, right? So yeah, so I'm going to talk to an accountant today that's going to tell us how we can deduct things from our taxes. Hey there, this is KG. I'm a realtor with Fairfax Realty in Greenbelt, where we have buyers to buy their dream home and sellers to sell their houses. And we do this in the Maryland, DC, and Virginia regions. So if you're looking to buy, sell, move, invest in real estate, contact us below. We'll take care of you. And don't forget to subscribe to the channel to get updates once we upload a new video. So it's tax season, it's January 2022. Before you know it, people will be getting their W-2 1099, and we don't want to pay taxes, right? So what are the items that we can deduct to reduce our taxes? So I'm talking to an accountant today. Introduce yourself, Mr. Accountant.
My name is Zopia Alumase, owner and CEO of Zopia Alumase Accounting and Consulting. I am a CPA, yeah.
Yeah, CPA, of course. So, what can you write off on tax?
Honestly, you can write off anything that's allowed by the IRS, i.e. the government. That's just a general rule. If the government allows it, then you can write it off. What you need to know is that the IRS uses the tax code to incentivize spending in the economy. And so what that means is that generally you can write off things through specific programs offered directly through the government or by the government or through your company or your employer, or anything that's allowable within certain purchases, like your mortgage or your home. There are certain pieces of that that can be deducted. You see, businesses are going to have biggest incentives in this space because the IRS or the government wants to encourage businesses to spend more. And when businesses spend more, the economy turns more effectively. So because the business is the key factor in turning the economy, you have the business owners have a much more flexibility when it comes to writing off things.
Okay, so let's break it down. When you say write off things, what does that do to your tax? You know, if I said I'm going to write some things off my tax, does that reduce my income so that I pay less tax? I mean, how does that work?
Yeah, so when a write-off is known as a business deduction, it's simple math. How much income did you bring in? That's your total gross income. A write-off or deduction reduces that total income. And so when you have that math equation, income minus expenses gives you net income. That net is taxable income. So whenever we say we want to write off an expense or write off something, we are simply saying we're trying to reduce our gross income so that we have a lower net income that is taxable.
Okay, so let's look at some scenarios, right? Because
Okay.
you said everything can be right up within the parameter. So let's look at some scenarios. Someone that is a W-2 employee with no business or no house, what can they write off?
Okay, so you can write off a few things depending on what job you are working. In some cases, if you are an educator, you can write off unreimbursed expenses for education if you're a teacher. You can write off contributions to health savings accounts. You can write off moving expenses if you're in the armed forces. Maybe you suffered a divorce. You can write off alimony payments, student loan interest that you've paid, tuition and fees. Other things that you can write off if you're spending higher than that, and if you're able to reach the standard deduction threshold, you might be able to write off large charitable contributions, medical and dental expenses, and casualty and theft loss. So if you hear the list that I'm explaining, that I'm saying, all of these are kind of like programs, incentives for people to live comfortable lives, like deductions for medicine, deduction for student loans, lifestyle deductions. So that's really the only things you can do if you don't have a business or you don't have a house.
Okay, you said lifestyle deduction.
Yeah.
What does that mean?
I'm saying lifestyle deductions like charitable contributions. You go to church, you can deduct some of those things.
Okay.
If someone came and stole your car, you might have gotten an insurance payout. Some of those costs could be deducted. If you paid medical expenses to go get your teeth fixed or your eye or glasses. Those things can be deducted as well, depending on if you reached a certain threshold. But other things, like if you're in school, there's a portion of your cost that can be deducted. And so, yeah.
Okay. So another scenario, someone that is a W-2 employee and an homeowner, what can they write off?
Okay, so now in this scenario, your write-offs become a little bit more flexible. You're only going to be able to write off about four new things, which is potentially mortgage interest and property taxes, as well as state and local taxes paid. However, there is going to be a limited amount that you can write off in relation to these things. And these things are only going to be written off within, if you're able to reach that standard deduction threshold. For individuals, that threshold this year is $12,550, and for married folk, it's going to be double that.
Okay. So here's the understanding. Someone that is a W-2 employee, is a homeowner, and have a side business.
Okay, so this is like the holy grail, person that does it all, right? So not only can you write off everything that I just mentioned in relation to the lifestyle deductions, as well as the new homeowners deductions, you're now going to have a whole world that's open up to you. You see, business owners can write off just about anything that helps their business grow. And if it's a bona fide business purpose expense, then 9 times out of 10, that can be written off. You can write off software. You can write off office supplies, equipment, payments to consultants or mentors, tax preparation fees, vehicle costs, phone and internet costs, really anything that helps your business move forward. One of the biggest things that you can write off as an homeowner, as well as a business, is if you have a specific space in your home that you're dedicating to business, and that becomes your home office. A home office deduction is one of the most powerful ways for people to deduct some of their personal costs on their business, in which you can deduct a portion of all of the overall cost in your home, like utilities, water, gas, lawn, security, even mortgage interest and things like that. Those major overall home expenses a portion of it can be deducted. It can be deducted, and that ratio is your office space in relation to the entire home.
Home. Okay.
Yeah.
Including, you say utilities, including internet, Netflix. You can write if you're using that for business, right?
Correct, including internet. I wouldn't say a Netflix subscription, but that's definitely personal. So there's still some judgment there, but definitely your internet, definitely your phone bills that are overall. So yeah.
Okay. So the other scenario, let me see the question. For someone that is a business owner, no house, what can they write off?
You see, the only limitation that they have is that they can't take advantage of the home office deduction. So in this case, the benefits really lie on what type of business that you're running. For if you're running a business that can be handled virtually, it's best, you're gonna want to be able to not just own a home. Actually, let me say this. You don't actually have to own the home to take the home office deduction. You can actually rent it. So a portion of your rent can also be deducted if you're renting.
Okay, if you're renting, okay.
Correct, right? And so you still have the advantage if you don't own the home. But obviously, if you're working a business, if your business can be done remotely and you have that dedicated home office, it'll be in your favor. But obviously, if you're doing construction and you're not home, then it doesn't really matter for you.
Okay. But somebody that's doing construction can have home office as well to do their paperwork.
They can, and that's where that's where the business owner kind of just behaves a little bit more savvy. I believe that every business owner should have a home office, so that they can take those deductions.
Okay, so we talked about a business owner, and then now is a business owner that is also a homeowner.
Yeah,
that's like icing on the cake.
Correct.
Okay, so you talk about these different deductions. What are the guidelines as far as records? I mean, I can say, oh, I spent $20 on lunch.
Mhm.
Do I need to produce those records? How,
Yeah, absolutely. So everything that we've mentioned cannot be must be supported. All the deductions that I mentioned must be supported some way, somehow,
Okay.
right? So if you're an employee, you're gonna get all of those your year-end statements, your W-2s, you're gonna get 1099s, 1099Rs from all your contributions and everything. And the reality, if you think about it, all that information is being produced mostly by the business that you're working for. Right. So now if you're on the other side and you're the business, you're going to have to produce that information for the business owners as well as any employees or contractors that you have on board. Right. And so what does that mean? That means that your accounting needs to be sharp. You need to either hire a bona fide CPA like myself, or you're going to have to get down and dirty and really start organizing all of your income, all of your expenses. When you have, if you're taking like business meal deductions, right? One of the major things that you're going to have to document is who was at that lunch with you or that dinner.
Really?
Yeah, what was discussed, and the cost and the vendor and everything like that. A simple way that you can keep records and all these things is just taking a picture of a receipt. You get a receipt, you might just jot down, Zoe and KG spoke about business deductions. And then write on the receipt.
I just been using my credit card. I know when it comes up, but to now you're saying I have to actually jot down the person that I have the lunch with or dinner or whatever, and then the business that was discussed. Okay.
Yeah. So that's not widely spoken about, that those documentation rules, but it's because most people are not getting audited. But in the case that you get audited, foolproof support will be getting that receipt and writing down that information.
Oh, okay. So documentation is very important. How long do you have to keep that documentation? Say you file your tax and you take all this deduction and you pay less taxes. How long do you have to keep all those documentation?
Well, for me and the clients that I serve, I'm required to hold all my documentation for 7 years. Now the amount of time for a person with their personal taxes, what they should hold, I'm not sure about that, but as a professional, I'm held to 7 years out.
Okay.
So I would highly recommend you holding 7 years worth of documents. Just file it away, put it on your external hard drive or your computer, and don't think about it. Just have it in case you need it.
7 years. Okay. So somebody this year, 2022, did not do what they're supposed to do in 2021. They didn't keep all the records. So now they want to prepare for next year. What can they start doing right now?
Yeah, our recommendation is one, change your mindset, right? Change your mindset and move forward with new goals and new aspirations. Don't look too much in the past about where your mistakes were. The best thing that you can do is, if you weren't doing it well in the past, is to start this year fresh. Say that I'm going to do it correctly this year. I'm going to keep track of everything and stay on top of it. It could be a hassle to go back and kind of clean that stuff up. So it's best to just go forward with a new slate, essentially.
Okay, so one of the things we talk about is somebody that's a W-2 employee, but then have a side gig. They do. So for them to take those deductions, do they have to register that business? Does it have to be a registered business like an S Corp or LLC, or can they just do? A lot of people do side gig without doing that. So
yeah, and this is the information like this, I think, is not widely known, but the reality is that you don't have to actually register your business in the traditional sense in which we think about. When people think of registered businesses, they think of LLCs, they think of S Corp, they think of C corporations. In actuality, those distinctions of entities are legal structures, meaning an LLC is just going to protect you from from lawsuits. protect your assets, protect your personal assets,
Okay.
right? It is not, you don't need it in order to start writing things off or reporting your business on your taxes. In fact, you're required to start reporting on your business on your taxes if you're doing your business to make money. So once you start wanting to make money with your business and you start making bona fide expenses, that's when you should start reporting it on your return. Even if it's just a side business, even if it's just a side business and you're not making maybe a couple thousand during the year, I would still encourage you to keep the same records and to report on your taxes like any other.
Okay. So it does not have to be legally structured business, can be a side gig. Like, because a lot of people buy and sell, do eBay, drop ship or whatever, but they're not registered.
Yeah, and what you're gonna see is that there's certain things, right? So when you're in business, when you start business without registering you with the state as an LLC. So there's two types of registration. There's the LLC registration, which is the legal form, and then there's the state registration, which is just, I'm gonna let the state know that I am doing business, right? And so letting the state know that you are doing business, it doesn't really cost much to you, if anything. And so what happens is that even if you start a business, you're going to assume the business is automatically going to assume like your personal name. You actually don't even have to register your name. From a tax perspective, it's all going to go on to, you report it as just your social security number with your name related to it. Now, when you start wanting to separate yourself a little bit from the business, then you're going to start, okay, I want to get an EIN, which helps me get a business account and things like that. But at the same time, the only registration that's required if you just start a business today or tomorrow is if you wanted to secure like a specific name, like Green and Black Consulting. Like there might be somebody else who's named Green and Black Consulting in the state. And so what you would do, you'll register with the state so that you can reserve the rights to that name, or at least tell everybody that I started a business with this name. Does that make sense?
Yeah, it makes sense. Okay. So you don't have to do that right away, Okay, so the other thing that I want to ask before we round up is, so a small business, I mean, it's somebody that is W-2 employee as a side gig, do they have to generate 1099 for themselves? Or how would they know, I guess? How would they know which income to report and expenses?
So they don't have, you don't need to generate a 1099 for yourself. 1099s aren't generated for you personally. You're always going to receive them. You're going to generate 1099s for any contractors or any individual or LLCs that you work with in the course of your business that you've paid $600 or more. So this piece can be a little bit confusing, even for a professional like me, right? So the idea is that if you're paying somebody who's not your employee, but you're using their services to generate income for your business, pay them, send them a 1099. Right. So I might have an office assistant, or I might have somebody running my social media, or I might have somebody a tax assistant, right? These people are not necessarily my employees because I'm not controlling them, and they may have multiple clients, but those are the ones that I'm going to send 1099s to. There's more things, there's more to it with the 1099s, but that's kind of the tip of the iceberg.
Okay. So generally, to reduce your taxes by taking deduction, will you say every W-2 employee needs to get a side gig?
No, I wouldn't say that. I wouldn't say that because you got to think about it. Like it depends on what's your overall goals, right? Reducing your taxes may be a cumbersome activity, right? Getting a business, it's not just writing something down. It actually takes a lot of work, and some people just may not actually want to run a business. And so there are other things that you can do instead of opening a business to reduce your taxes. We talked about those lifestyle deductions, right? We talked about charitable contributions. Maybe you don't want to open a business, but maybe you're a big giver, you're a big tither at your church. If you donate to the threshold, you'll be able to take advantage of those deductions. Let's say that you have a health savings account. You put some money into a health savings account, you can take deductions on that as well. And then even if you're not a business owner, I would encourage everyone, even if they're not a direct business owner, to get into investing. You can get some deductions out of investing depending on what type of investment that you're investing in. For example, if you invested into a small business, you maybe have a friend who started up a t-shirt company. You're a part owner in that t-shirt company, right? And so let's say that company makes 100,000 but deducts 75,000. They're going to give you what is known as a K-1 report for being a partner into that company. So they're handling all the business activities while you're staying at home, kind of just being passive, and they'll send you the summary of everything that happened. So in that way, you can be a business owner without doing the business, which that makes sense.
Yeah, makes sense. But now, what does that K1 do?
That K1 just sends out the summary of all the activity to all of the owners and gives them the portion that they're responsible for.
Can that be used as part of tax to reduce tax? Okay.
Yeah, it's absolutely. Here's a strategy, right? Here's one strategy. Let's say you go into a rental real estate property, which is one of the best ways to take advantage of this. You go into a rental property with two other partners. Typically, if you're dealing with rental real estate, then depreciation is involved with that real estate. That business for that property may, on paper, come out with a loss for the business because of the depreciation. Now that loss is going to be divvied between the three owners, and one of the owners, let's say you're an owner but you're passive and you're not really on the day-to-day, you're going to be able to take those losses and apply them to your taxes in general. And so it's going to reduce, those losses act as a deduction. They're going to reduce your tax burden.
Oh, okay. So you really don't need to go out and be doing business if you really don't want to do it. Okay. That's good. So, like I said, so we are starting on the tax series because this is the tax season. I want to give people information so that they can pay less taxes. Nobody wants to pay taxes, right?
Nah.
I want to pay less taxes. All right. Thank you. So can you drop your information one more time if anybody has questions?
Yeah, certainly. Again, my name is Zopia Llc. I'm a CPA and owner of Zopia Llc Accounting and Consulting. You can contact me about going to our website, llcac.com, or you can email us at zopia at llcac.com, or you can call us at 301-294-8900. Cool.
Thank you, Zo. So next time we're going to talk about top 10 mistakes that people do when they file their taxes. Until next time, listen, if you're looking to buy, sell, or invest in real estate, contact me below so that I can take care of you. And don't forget to subscribe to the channel to get updates once we upload the video. Ciao, ciao.